Welcome to my channel. In today's video, we're diving into the exciting world of investments and revealing the ultimate guide to crafting the best investment portfolio for 2023. Whether you're a seasoned investor or just starting out, we've got you covered with expert insights, strategies, and a deep analysis of the market trends. So buckle up and get ready to maximize your financial potential. Let's jump right in. Investing today presents a unique challenge compared to 40 years ago. With an overwhelming number of options, including 5,600 US exchange-listed companies, 3,000 ETFs, and 8,000 mutual funds, it's clear that the investment landscape has exploded. And why are there so many choices? Well, sadly, marketing and profit-seeking drive the proliferation of investment funds. To navigate this maze, we need to narrow down our options and choose an investment strategy. But first, let's establish a baseline. If you had invested $1,000 in gold in 1980, it would be worth around $2,430 today. In contrast, that same $1,000 invested in the S&P 500 would be worth around $110,000. So let's learn from the past to shape our future investments. But what is the perfect investment strategy for the perfect portfolio? We'll explore this question together. One popular strategy, inspired by Warren Buffett, combines buy and hold with value investing. The key is to hold investments for the long term, even decades, focusing on high-quality companies that can withstand any challenge and remain successful for years to come. While perfection may be elusive, we can strive to build resilient portfolios. Value investing, popularized by Benjamin Graham and embraced by Warren Buffett, involves identifying undervalued stocks and purchasing them at a discount. While it sounds appealing, most of us lack the time and expertise to assess a company's true value. However, we can still adopt the buy and hold aspect of Buffett's approach, which is relatively straightforward. On a more tactical level, Buffett directed that his wife's inheritance be invested primarily in a 90% stock index and 10% short-term government bonds. This is what is known as the Warren Buffett ETF, and it is deviating from the conventional advice of adjusting stock allocation based on age. Buffett's deviation from the conventional advice of a conservative 60% bonds and 40% stocks for his wife's portfolio may seem surprising. However, a study by a Spanish finance professor sheds light on the rationale. The study analyzed different portfolio splits over 114 years, considering low withdrawal rates during recessions. The 60-40 split consistently had the lowest rate of failure, while the 30% stocks and 70% bonds had the highest failure rate. This suggests that the potential gains from stocks outweigh a heavily bond-focused approach. While Buffett's wife may not worry about running out of money, the rest of us aim to maximize growth while minimizing risk through a diverse investment strategy. Now, index investing, popularized by Vanguard founder John Bogle, involves investing in broad market indices like the S&P 500 instead of individual stocks. This strategy led to the rise of ETFs. Bogle believed that low-cost index funds outperform actively managed funds, making ETFs one of the best investment options for most investors. Warren Buffett made a famous bet in 2007 that highlighted his belief in the long-term superiority of low-cost index funds over actively managed funds. The bet was between Buffett, one of the world's most successful investors and the chairman of Berkshire Hathaway, and Protégé Partners, a New York-based asset management firm. The bet involved a wager that over a 10-year period, an investment in a low-cost S&P 500 index fund would outperform a selection of hedge funds chosen by Protégé Partners. To formalize the bet, each party put up $320,000, which was invested in bonds to grow over the duration of the bet. The crux of Buffett's argument was that most money managers fail to beat the market consistently over time, primarily due to high fees and the difficulty of consistently picking winning stocks. He advocated for investing in low-cost index funds that track a broad market index like the S&P 500, as they provide diversification and generally deliver solid returns over the long run. At the end of the 10-year period in 2017, Warren Buffett's theory was proven correct. The S&P 500 index fund that he had chosen, specifically the Vanguard 500 index fund Admiral shares, achieved a compounded annual return of 7.1%. In contrast, Protégé Partners' selection of 5 hedge funds managed an average annual return of only 2.2%. Buffett's victory in the bet highlighted the challenges faced by actively managed funds in consistently outperforming low-cost index funds. While some active managers may outperform the market in certain periods, it is difficult to sustain such outperformance consistently over the long term. Additionally, the high fees charged by many active managers can erode returns and make it even harder to beat low-cost index funds. Buffett's bet drew attention to the advantages of passive investing and has further popularized index funds as a core investment strategy for individual investors. It emphasized the importance of keeping investment costs low and focusing on long-term returns, rather than trying to beat the market through active trading. Here is a portfolio strategy that leverages passive index funds. It is called the Coffeehouse Portfolio. The name came from a book, The Coffeehouse Investor, by Bill Schulthesis. It is a simple and diversified portfolio designed to provide consistent returns while minimizing risk and volatility. It uses only passive index funds to allocate your funds. It doesn't need you to constantly review or fine-tune the portfolio. You just pick a predefined ETF in the following way. You can see that the actual portfolio is a variation of the 60% equities, 40% bonds portfolio. However, the Coffeehouse portfolio takes the stock allocation, splitting it into 6 different asset classes: a large cap fund, a large cap value fund, a small cap fund, a small cap value fund, an international stock fund, and a real estate investment trust fund. The bond asset allocation is simply a total bond index fund. Let's continue with the comparisons. Since 1990, the Coffeehouse strategy has produced an 8.5% annual return, while the S&P 500 averaged a 9.9% annual return. Although the Coffeehouse strategy had a lower return, it performed better during market crashes than the S&P 500 index, thanks to its allocation to bonds and diversification among stock indices. For example, the table and chart below compare the returns and volatility of the Coffeehouse portfolio versus the 60% total stock and 40% total bond portfolio, and the 100% US large cap growth portfolio. Going into 2023, my personal investment strategy primarily follows Buffett's approach, which has 90% in stocks and 10% in fixed income assets. The fixed income portion includes bond ETFs and money market funds for the most part. For stocks, I'll diversify across multiple index funds. I'll also allocate a small percentage to international stock indexes. The distinction between domestic and international markets are becoming blurry these days, as companies like Apple and Microsoft generate significant value overseas. By investing internationally, I aim to take advantage of lower multiples in companies in the rest of the world and to mitigate the impact of a potential US recession. Since World War II, we've had 12 US recessions and 5 global recessions. Having dedicated international stock in my portfolio provides a powerful hedge against potential overlap with US economic downturns. One important aspect I didn't mention earlier is the challenge of maintaining a fixed allocation. Let's say you have a split of 60% stocks, 20% real estate, and 20% bonds. To keep this balance, you would need to rebalance your portfolio regularly, like each quarter or every 6 months. However, if you rebalance outside of a tax-advantaged account like an IRA, you may incur capital gains taxes and potentially lose some of your investment. Obviously, everyone's situation is different, but I will try to implement my retirement investment portfolio through a Roth IRA or another tax-advantaged account. For the investment-savvy individuals out there, leveraging dividend stocks to supplement fixed income assets can be an excellent approach. In fact, we have released another video on the topics of dividend investing. Feel free to check out that one right here. However, it's important to remember that there is no perfect investment strategy or portfolio. Each person's approach will vary based on their circumstances and goals. The key is to take the time to create a well-thought-out investment strategy that aligns with your needs. By doing so, you increase your chances of achieving financial success. When it comes to investing, considering your personal situation, risk tolerance, time horizon, and financial commitments is crucial. Failing to have any strategy at all will consistently yield poor results. As mentioned before, you can explore a variety of ETFs and mutual funds offered by different brokers. These options cover total US market index, international large cap index, and bond funds. Take advantage of these resources to shape your investment strategy and strive for better outcomes. And that wraps up our exploration of the best investment portfolio for 2023. We hope you found this video informative and empowering. Remember, investing is a journey, and it's important to adapt and stay informed as the market evolves. If you enjoyed this video, don't forget to hit the like button and subscribe to our channel for more valuable content on personal finance, investment tips, and wealth building strategies. Thanks again for watching, and we'll see you in the next video.